In this session, you will learn about FX quotation, types of quotes, pips, market maker and price takers, and largest FX traders. Let us begin with FX quotation, which is one of the biggest sources of confusion for those new to the currency market. A quotation is the ratio to convert one currency into another, that is, the price of one currency, the base currency, in terms of the other currency, that is, the quoted currency. It is also known as the exchange rate. As mentioned, the quotations are made using two currencies, which are the base currency and the quoted currency. The base currency is the first currency of the quotation, while the quoted currency is always the second currency. The base currency is always equal to 1 unit of that currency. For instance, in the example in your screen, the base currency is 1 pound, while the quoted currency is variable depending on foreign exchange prices based on 1 unit of base currency. When the exchange rate goes up, it means the value of the base currency is rising relative to the other currency. This is referred to as currency strengthening, and when the opposite is the case, that means currency is weakening. For example, in FX1, the Great Britain pound is base currency while euro is the quoted currency. As with most trading in financial markets, when you're trading a currency pair, there is a bid price and an ask price. The bid price is buying rate, while the ask is the selling rate. The profit or the spread that a trader will earn is the difference between the bid and ask, which is also called the spread. Spread includes brokerage, taxes, and the profits. The bid rate is to buy the base currency, that is the GBP, while at the same time sell the quoted currency, that is euro. The ask rate is to sell the base currency, that is GBP, while at the same time buy quoted currency, is that euro. Using the quotes 1.2083 by 5, a trader can buy pounds at 1.2083 and sell them at 1.2085. This way he can earn a profit of 20,000 euros on an investment of 100 million pounds. Now let us look at the type of quotations. There are two types of major quotation: direct quotation, which is also known as the price quotation, and indirect quotation, which is also known as the quantity quotation. Firstly, let's understand direct quotation. A direct form of quotation is one where the rate is the price for the foreign currency per unit of domestic currency. As just mentioned, a direct quotation is known as a price quotation. Most of the exchange rate in markets such as USD to JPY, USD to HKD, and USD to MXN are also quoted using a direct quotation. As shown on the screen, the rate of USD to INR is Rs 60. This means for $1 you will get 60 Indian rupees in return. So if I have $10, how many rupees will you get on selling? Can you calculate the answer? The answer is Rs 600. If prices are Rs 60 to a dollar, a direct quotation is the most popular form of an FX quotation. Moving on to indirect quotation, which, as we mentioned, is also known as quantity quotation. And the indirect quotation is one where the quantity of foreign currency per unit of domestic currency is published. For example, INR to USD is equal to 0.01667. This means that 1 Indian rupee you will get 0.01667 USD. So if I have rupees 1000, how many dollars I will be able to buy? I'll wait for 5 seconds for your answer. The answer is $16.77 if the prices are $0.01677 for a rupee. It is worth remembering that direct quote and indirect quote are reciprocals of each other. Therefore, a direct quote will show USD to INR, which is 60, whereas an indirect quote will show INR to USD, that is 0.01667. Based on the market price, foreign exchange rate quotation normally consists of 5 significant figures, starting from right to left. The first digit is known as pip, the second digit is known as 10 pips, and so forth. A pip or percentage in point is the smallest change in price of a given exchange rate. The currency pairs are quoted to 4th decimal place to be accurate. An exception is JPY currency, where the pip is calculated at the 2nd decimal place. Euro to USD is quoted at 1.2345 and changes to 1.2346. The change in pip would be 1. Similarly, if rate is 1.2345 with 10 pips, you will get 1.2345 plus 0.0010, which is 1.2355. Likewise, if the rate is 1.2345 with 100 pips, you will get 1.2345 plus 0.0100, which is 1.2445. Let us move on to the market makers and price takers. The market maker publishes the exchange rate of currencies in market. They are also known as price publishers or price makers. A market maker will make a profit on the spread, while the counterparty will make the role of a price taker. The price taker will suffer a loss on the spread. Investment banks primarily play the role of market makers. Moving on to the features of market makers. The market makers stimulate a market by providing two-way quotes for various currency pairs. An investment bank plays a very vital role in the financial market by acting as a market maker. The role of a market maker is to simply infuse liquidity in the market where the participants find the rates competitive enough to buy and sell. When there is low liquidity in the market, the spreads between two exchange rates widen, leading to a high profit margin. An investment bank can then play a role of market maker by publishing competitive rates and enticing the other participants to trade against them. This will still earn them a spread, but a lower one compared to a low liquid market. So a less liquid market could mean higher spreads, but these markets are also highly risky as it might result in scarcity of buyers or sellers. By publishing bid and ask prices, they entice other market participants to buy and sell the products. There is no brokerage. Their earning is spread between the ask and the bid with the quote. Let us take a look at an example to understand this concept of market makers a little better. Let's assume for some time that Euro to USD market is low on liquidity and participants are not willing to buy or sell the currencies. The spot rate is 1.20. The bid-ask quote between the two currencies could be large, that is 1.15 or 1.25. A market maker can then come and publish a quote with a smaller spread, that is Euro to USD is equal to 1.1950 versus 1.2050. Here, Euro is the base currency. USD is the quoted currency. 1.1950 is the bid or the buying rate for Euro and selling rate for USD. 1.2050 is the ask or the selling rate for Euro and the buying rate for USD. This means is that the market maker is willing to buy Euro and sell USD at 1.1950 and sell Euro and buy USD at 1.2050. And the price taker then has to sell Euro and buy USD at 1.1950 and buy Euro and sell USD at 1.2050. A price taker gives a requirement of buying 10 million euro. If you look at the direction of price taker, you will see he buys Euro, sells USD at a rate of 1.2050. The chosen rate is therefore 1.2050. The price taker will then receive 10 million euro and pay 12.50 $0.05 million US dollars. Now using the same example, we will see that if a market maker buys and sells at quoted price published, they will make a profit of $0.01 per euro, which is spread between 1.1950 and 1.2050. In other words, if you invest 100 euro, you will be able to make a profit of $1 or its equivalent in euros. The spreads can even be lower or higher depending on the volumes of currency pairs. Now let us assume he executes trades at 1.1950 and 1.2050. What happens? From a USD point of view, the market maker will pay 1.1950 USD and receive 1.2050 USD. Hence, this USD account is now plus 0.01, which means he ends up receiving a higher amount in USD while ensuring Euro account is flat, which is win-win situation for both of them. A market maker will send 10 million euro and receive 12.05 million USD to match the trade with the price taker. Using this logic, most of the market makers will execute thousands of transactions in order to make a higher amount of profit. Finally, we come to largest traders of foreign exchange as of May 2015. The list of largest foreign exchange traders comprise top investment banking firms like Citigroup, which commands 16% market share, Deutsche Bank, Barclays, JP Morgan, followed by likes of Swiss Bank, AG, and Bank of America Merrill Lynch. You have reached the end of this session on foreign exchange quotation. Thank you and goodbye.